I mean, Neil's going to shudder at me talking like this. Like, just from like an Austrian perspective, like the gold reserves were really a nice way to kind of balance the whole world and make sure you stuck to your knitting and didn't get out over your skis. Obviously, it caused massive problems when you did get over your skis, but learn from your mistakes. Neil's not an Austrian, but
I'm a monetarist.
That's so 1980s, Neil. Come on, man.
Okay, well, you're so 1600s.
In fairness, it was the mid 1800s, but you're right.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, October 17th, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Another week of a shutdown, another week of no data. Where's the pain point? Where's the pain point coming, guys? Anytime soon? I flew down from New York to Charlottesville. I'm at a parents' weekend. And I got to tell you, the TSA, it wasn't that bad. So from a flight perspective,
I mean, the amount of oxygen you just gave the shutdown is probably more than the national news media in the last week. It kind of tells you everything you need to know, right?
Well, I think when you talk about the actual pain point, I don't know that I see one before Thanksgiving, to be honest, because if the TSA situation gets worse, then that's when these lawmakers are going to hear a lot from their constituents. If they wanted to travel home, I guess the House has already been home for most of this time. That's the one I would watch for.
I mean, isn't Trump kind of neutering the leverage the Democrats have by basically finding workarounds to fund specific things, right? So you mentioned the TSA. I mean, he basically saved the WIC program with tariff revenue. I mean, obviously that's legally questionable but that's part of the issue with the shutdown, right? Like you see like the party shutting the government down, in this case, the Democrats, I think. You're ceding political power to your political adversary.
Well, yes.
Oops.
Yes.
Well, you sort of last week you got around the pain point that people thought would be paying the troops. Trump found a way to do that. Again, lawyers can question whether or not did that legally. And then you talk about what's the next upcoming potential pain point. Democrats seem to be hoping it's going to be November 1st. That's when these letters are supposed to go out with respect to the ACA subsidies. But you look at in the fine print there, and it's, you actually have till December 15th to enroll in it. You can actually go as far as January 15th. So that's where I'm saying the real pain point that I see potentially is this Thanksgiving travel if the TSA conditions worse.
Did I see that? I'm just asking a question. I don't know if this is true, but I heard that the Democrats are challenging paying the troops in court. Like they think it's you can't do it. And so I'm like, guys, like there's a point where you your optics are horrible. Just let it go.
Their messaging is also horrible, right? Because they're calling it the Republican shutdown because the Republicans have all three branches of Congress, while also simultaneously saying they're fighting by keeping the government shut down. So which is it?
Well, I don't know that.
I do think they're losing the messaging war. If you look at, to me, there was an interesting political report because a couple of weeks ago, it looked like Trump was taking more of the blame because of the actions he was taking. But now you look at what's happening and the blame is getting more spread across the parties, right? So it's sort of, if that's the case, then maybe the Democrats are losing some of their, whatever political momentum they may have had.
Well, one issue you have right now that'd be last to know with a lot of other things to talk about is just, who's the hostage here? It's the federal workers. They're going to miss their first full pay period this coming Friday. And the problem with the situation now that the roles have been reversed with Democrats sort of being the minority party shutting down the government is they're the hostage. but Republicans don't mind, many of whom would prefer to shoot that hostage. So I don't know how effective of a leverage point that's going to be, which is why, again, I don't see a way out of this before November. I'm not sure that November 1st, that ACA deadline, is really a forcing function. So the only thing I really see on the horizon outside of some sort of exogenous event, and by the way, we're sort of past the storm season, so you wouldn't have that sort of federal response forcing function for like a hurricane, presumably is Thanksgiving travel.
Shooting the hostage. There's the title.
Wow.
Okay.
Okay.
Good night, everybody. See you later.
And that's a wrap. All right. Well, in the absence of government data, we had earnings kickoff this past week with the banks, and lo and behold, credit concerns. Jeff, are you seeing anything from your perspective in the credit markets that sort of elevate your concern level?
Yes and no. I don't remember if we've talked about it on the pod. We've been highlighting for weeks and maybe months now the deterioration in private equity firms. I won't name the names, but you all know who they are. If you don't, look them up. One would be an animal that makes this noise. Woo, woo, woo. And there's a couple others, but they're weak. And what's interesting is they're weak. The weakest of the lot of the private equity firms are the ones that have the most credit and private credit exposure. So that's pretty interesting. Obviously, we saw the First Brands issue. We saw double B versus triple B spreads spike around that. The question is that just episodic, idiosyncratic, whatever big word you want to use, that's, kind of a one-off. Right now it appears to be that. Bloomberg's been running a host of stories about regional banks and lax lending standards and, giving loans to illegal immigrants who then, for fear of their car loans, for fear of their deportation, just simply drive their car, i.e. their collateral, into Mexico, and it disappears, which is pretty great. I wonder who's got the blood on their hands of that underwriting standards. But look, I think, a couple things, and this is just yesterday. I mean, we had the bank trends are still okay. There's certainly some regionals that look vulnerable. Some oversold conditions are developing a lot. In fact, I would say, let me see. In terms of financials, we had 52% of financials yesterday make 20-day lows. Historically, that's a pretty good washout signal, at least in the near term. I wouldn't, that has nothing to do with trends over the next 6 to 12 months. But it does, very short term give you this kind of concentration point. I think the bigger, I don't think regional banks are the problem. I don't think they're going to be a problem. We'll see. Maybe, I'll whistle past the graveyard on that one. But the trends are still good. If they rally and then they fail, then we're going to have a problem probably in 2026, but I don't think they're a problem right here. The bigger problem in my view of financials, and I don't think this is credit specific, nor do I think it's systemic, is insurance. Those names have been topping for a while. They're rolling over. They look weaker. And then obviously, as we talked about, the private equity guys. So look, that's all happening as 2-year yields broke to a new cycle low. 10-year yields broke through 4%. We talked about the 50-day crossing under the 200-day moving average on the 30-year bond yields back, I think it was a week ago, maybe it was 2 weeks ago now. So the yields are trending downward, and that is historically good news for equities. So we'll see. I think right now the focus is going to be what happens to the economy. The data that Neil talks about in the consumer, I think has a short-term impact on giving us maybe a fresh oversold condition. But the market will start to discount the idea of a lower interest rate environment, and that will prove to be bullish for stocks.
So this is different than sort of SVB, right, Neil?
Yeah, I mean, this seems to be about credit risk, not duration risk, right? I mean, so in SVB, you basically had a regional bank that, frankly, no one really ever heard of. Kind of betting on low interest rates forever. So they piled into long-term bonds and MBS. And then obviously we all know what happened. The Fed had to rapidly normalize interest rates and it blew up, right? And that's what that was. And obviously when there's like a pain point in the financial sector, there's it kind of spreads to other things too, right? Like, so you had like the whole First Republic thing, and anyway, and this is about credit risk. This is about whether you're going to get paid back on loans you made. I think that's the distinction between the two. I mean, we'll see what happens. I don't know. I mean, I do think that at some level you're either betting on delinquencies continuing. I mean, because the big banks are all showing lower credit card delinquencies, healthy consumers and so forth. But at some level, you have to bet on whether you think unemployment will keep rising or delinquencies will keep falling. I don't think those two things can be disconnected for that long.
We had a question come in from Paul Ciro to our Twitter account this week, who asked sort of about delinquencies and your view of the overall health of the consumer given the rising delinquencies, some of the other stuff. So in your view, this is just one more piece of the puzzle for the consumer that says, that we're headed towards a sort of suboptimal outcome for consumer spending. Right. Yeah,
I mean, I hear what Jeff's saying on interest rates coming down, but ultimately it's important to understand why they're coming down, right? Like, so it's if rates are coming down because there's increasing concern among fixed income investors about the economic outlook, that ultimately is not going to be a good scenario for stocks. I mean, we also know that historically, like the initial kind of rate decline is, equity investors love that. So it's like the kind of Fed mana, and we're betting on cuts. I mean, this is sort of, equity investors taking another bite at the soft landing apple, in my opinion. I mean, you had it last year, now you have it again. But it's, historically, it's sort of ahistorical to kind of have two bites at that apple inside of a year. So we'll see. What I would just say with respect to the labor markets, I mean, we don't have data in the US right now, but you are seeing like unemployment go up in the entire Anglo-Saxon world. Like anywhere where English is spoken, unemployment's going up. Australia, cycle high. Canada, cycle high. UK, cycle high. New Zealand, cycle high. So I think it would be like a little bit, it would be not wise to assume that that law of gravity is not also kind of applying to the U.S. And we know that unemployment's generally going up in the U.S. So that's kind of where we are. I've been saying that the big macro data story right now is the disconnect between GDP, which has been quite strong, and the labor market data, which has been quite weak. But the stuff that's been coming out, generally speaking, has been kind of more consistent with the labor market data, right? Like, so you had, the Beige Book, which is sort of a survey of all the Fed's business contacts. You had more districts, contracting this time versus the last time that was released. So it's not exactly consistent with an economy that's growing over 3%. My sense is that job finding rates remain very, very challenging. There's still plenty of anecdotal evidence of ongoing layoffs. Nestle was just the latest one. There was a CNBC article talking about how banks are holding the line on employment, kind of hiring freezes and so forth in the holiday season, among retailers as well. So nothing really tells me that unemployment is going to stabilize here. It's probably still going up. And, we have a very strong conviction in that.
And there's not going to be a drumbeat from Washington, Pavs, about, deregulation. And this is why, the banks are lending, riskily, or however you want to say that. That's a word.
Well, I'm not sure that it is, but what I am sure of is that the Trump administration is really putting a great emphasis on growth. And I think they think banks are going to play a very important role in trying to achieve their goal there. And I think that's important because deregulation is a big part of it. You think about the regulatory sort of pendulum in which ways it swings. After the great financial crisis, it swung very much in the direction of greater regulation. It's probably not surprising when we saw growth in private credit as a result of that. And so now I think the concern is, as we're swinging more towards deregulation, and if you're looking at maybe the lack of visibility from regulators, or maybe not even wanting to focus on what those potential concerns are in the private credit market, just because they don't have that much visibility there, is that sort of the next risk, to sort of watch out for? That would definitely be a significant impediment to the administration's, again, emphasis on growth and the important role that banks would play there. But I don't see this, at least in the near term, as any desire to shift away from this emphasis on deregulation.
Right. And then beyond that, when we start, talking about, as we did in the beginning, about the shutdown and the pain points and the optics, now we've got not paying federal workers, but we're bailing out Argentina. Is that enough to get everybody amped or no?
I don't know that that's going to move Republican lawmakers. I mean, at the end of the day, Trump really has a very strong hold on the Republican Party. I do think you have seen some cracks, particularly those from agriculture states, saying, why is it that you're bailing out Argentina when Argentina's taking the soybean market away from U.S. farmers? And that's something I think that the Trump administration is sensitive to, which is why Neil mentioned redirecting tariff revenue to cover the WIC program. It's also apparently going to go to cover farmers that are going to need aid as a result of China not purchasing our soybeans. So I think that's one way to maybe placate some of those concerns from the lawmakers. But where that tariff revenue isn't going is to paying down the debt. And so that's something that I think people need to be conscious of as we move forward. And my guess, again, soybeans are probably going to be a big point of conversation when Trump meets with Xi Jinping. I'm assuming he's still going to do that on October 29th. And he may end up bringing those conversations up to other Pacific nations that he meets with prior to that.
Has anybody been to Argentina? Anybody on this? I've been a lot of places. I've never been to Argentina.
Please, Neil, say yes.
Oh, here we go.
Please,
right,
please.
Neil. How about Argentina?
I haven't been to Argentina. I haven't been to Argentina.
But why don't you pretend that you have been? Like, how was it?
I mean, I'm just afraid to go use an ATM over there because usually the people over there are throwing big bricks at the.
There we go.
At the Western banks.
Wow.
But to your question, Steve, though, about Argentina, like what to watch for, watch October 26th. That's where they're going to have a legislative election there. And obviously, Trump and the administration is very clear. They want to influence that. They want Milei's party to do well so he can continue to pursue these reforms. If the election doesn't go his way, that is going to call into question that. My guess is you probably see some sort of reaction, at least from a market perspective, to that.
Why do these people have elections on Sundays? I don't understand that. I guess everybody's home. It's a good Catholic country, so everybody's home.
Well, I think the question is, why do we have them on Tuesdays on a work day? I think that's the better question.
Without the day off.
Right. They should just give it the day off. And then
if you want to be conspiratorial, then you get into what party benefits from the people that are working and voting. But
I was going to say, if you're an illegal immigrant, you're not working anyway, probably, at least in a one of those jobs. So you can just show up on Tuesday. It's no problem to vote.
Neil,
let's bring it back. Bring it back on the rails, Doug.
So, Neil, you mentioned the fear of going to an ATM. There is this sense, Jeff, about FOMO out there, right? And about, missing out on this rising market. Obviously, we're in the camp that, things are up and to the right. You had a piece in your weekly survival guide this week that goes out to all of our clients about Sir Isaac Newton and perhaps his gravitational pull towards FOMO.
FOMO, fear of missing out. That's not a 18th century term. I think that's a 21st century term. But yeah, look, I mean, back in it was actually 400 years ago in the between 1719 and 1720, there was a bubble in what is known as the South Sea Company. So it was known as the South Sea Bubble. And basically it was a company that was set up. It was given monopoly powers to extract all the trade with South America, right? So kind of the discovery of the New World, and this was set up to profit from that. So Isaac Newton and this all happened. I mean, we're not talking about like this was decades. This all happened like in months and weeks. But Isaac Newton bought from the records of the Royal Society, which we were able to get a hold of thanks to the internet. Sir Isaac Newton bought somewhere in late February, early March. It's not exactly clear. But either way, I mean, within a couple of weeks, he bought into the South Sea Bubble, the South Sea Company, I should say. It wasn't a bubble then. He basically doubled his money in about 6 to maybe 8 weeks. He pulled the ripcord on that and said, "Thank you very much. I did great, and I am the smart guy that I think I am." Now let's put Sir Isaac Newton into context here, right? Probably a top 5 individual ever to live on the planet, at least what he did. I mean, we have Newtonian physics because of him, right? So he formulated the laws of motion and universal gravitation. He invented calculus to help himself figure out these things of celestial movements, right? He built the modern telescope, and he also developed the scientific method, right? The null hypothesis and all that good stuff. Things that we all use today, things that everybody believes in, things that, I mean, this is a creme de la creme of intellectual thought. He doubled his money, and he thought he was a genius, and he is a genius. But from that point, from the point at which he sold, the South Sea Company tripled from there. And again, this isn't over years. This is over weeks. The South Sea Company tripled, and he got sucked in. And he bought very near, sometime in late June, it appears, very near the top, which was at the latter part of July. And his estate showed that a significant portion of his estate's value was still in the South Sea Company. So, the whole point is that even this uber rational individual was sucked in by FOMO and made a terrible decision. It's not so much the decision. I think, and the way that I always think about it is you want to play from a position of strength. And I actually think there's a relatively high probability. It's not the baseline probability, but I think there's a relatively high probability that we enter into one of these bubble periods because we're going to have a benevolent Fed. We're going to have softer rates going forward. We're going to have a weaker economy or weaker growth that's going to give the Fed a lot of ammunition. And we've got these blue sky expectations around AI and all things considered. And I think you're going to get this funneling effect of these cheap dollars, if you will, or this liquidity that goes into the market. I think that's a real risk. And my point is, do we want to be there today and be a part of it on the way up, or do you want to get sucked in like Isaac Newton at the end? And I think playing from a position of strength says, look, there's not enough evidence in the market right here to be bearish. I think tactically all this stuff is consistent with what we've talked about, which is, high put call ratios, a little bit at the edge of high sentiment and some of these areas in tech. But all things considered, I think, 2026 has the ability to be an epic year. I don't know if that's good long term, but I think it could be very, very dangerous. And you don't want to be the last guy in that type of environment. So anyway, don't be Sir Isaac Newton is what I would say.
But in the meantime, you've got this headwind of trade and, the trade tensions with China, Steve. I guess there's a meeting coming up at some point at the end of October. Is that right?
But by the way, that stuff sets up for this,
exactly.
Right?
That's
the near-term stuff, the near-term weakness, the near-term, these auto loans, all that ends up actually setting up pretty bullishly. And, Neil and I are going to be disconnected on this because I think, the real economy and the real data is going to be weaker, and that's going to feel bearish, but in a perverse way, it's going to set up where, AI doesn't need the real economy, right? AI is not dependent on, whatever workers or spending or, and that's what happens, right? In these environments, that type of thinking, not that I drink that Kool-Aid, but that type of thinking becomes pervasive. I mean, I remember clearly, unfortunately, I've been around a long time, but in every one of these, there are excuses as to why the Fed doesn't matter, as to why credit doesn't matter. And I will tell you, the one that I remember most vividly was in 1999, and a institutional salesperson at Lehman Brothers walked into my office and he said, why tech is going to go, it doesn't matter. They don't have debt, and therefore they're immune to interest rates, right? It doesn't matter. So this story is just going to keep going. Of course, the real economy is not immune to interest rates, who buy software and everything else. So there's always excuses like why, this time it's not going to matter, but it will.
Well, are you suggesting that an institutional salesman was using an excuse?
No, this was a good institutional salesman.
Damn it. Steve, over to you. Quickly, over to you. China, the trade tensions.
Well, that may be hard to address quickly, but look, I will say this last week of October 1st, remember, we have a lot of things going on the policy front. We talked about the Argentinian election, the 26th. Trump's supposed to apparently meet with Xi on the 20th. I put the odds of the meeting probably about 80%. There's always a chance that things deteriorate, and we had a lot of posturing, that, put it politely, this past week. Suggests that meeting's not inevitable. And if that meeting were to collapse, and obviously I think both Xi and Trump would be forced at that point to follow through on some of these trade restrictions that they're talking about, and there'd clearly be a big market reaction to that. And then, as part of this meeting, this is on the sidelines of the APEC summit in Korea. So my guess is Trump's going to be meeting with a lot of leaders there in Asia as he travels through there. So again, look for headlines there. And that's important because that's going to deal with a lot with China. We talk about Southeast Asian countries in particular. There's concern of transshipment. China basically, at this point, the U.S. is saying, we're not going to take your goods. We're more or less blocking off our consumer market. So in their export economy, they have to find somewhere else to dump this and maybe look for ways around that. And that's really a point of tension between the U.S. and China, and a big part of Trump's trade goal, sort of dealing with China and sort of how to think about it big picture. The thing that jumped out at me this past week was you saw both USTR Jamison Greer, United States Trade Representative, and Treasury Secretary Scott Bessent talk about moving away from this term of de-risking, which usually is sort of the softer sale, and talking now about decoupling and sort of the risk that China's export controls was moving the U.S. in that direction. And again, I'll use this analogy before. I'm going to just reiterate again. I think both China and the U.S. are moving in the direction of a divorce. That said, I think they're analogous to a couple that's decided to separate, but they want to live in the same house in the near term because they have a sub 7% mortgage and sub 3% mortgage rate. And so they really want to reduce that economic disruption. So it's really about managing that separation in the near term, which is why I'm so optimistic they're going to meet. I'm optimistic that we're probably just going to see another extension of sort of more or less the status quo. But the next couple of weeks will be really important.
So who's doing the laundry in that situation?
I think that's open to negotiation.
All right.
Well, on that, let's move.
We'll talk about transshipments on another episode. I need a definition of that.
Let's move over to the mailbag. Harry, good morning. As a reminder to people, please submit those questions on our social media platforms. We're on X, we're on Instagram, we're now on Twitter. So submit those questions. We'll send you a nice RenMac trucker hat. Although we are getting a little low on those, so we're gonna have to restock with some new versions of those hats. I
got new ones on the way.
There we go.
New ones on the way. I don't know if we want to reveal or not, but I think they're pretty sweet.
We'll reveal once we have them physically. This is just in time inventory, so we want to make sure we get them.
I got a size 8 for Harry.
Harry, you're up.
Harry, what's your blood pressure today? Do you know?
It's quite lower down a lot.
Oh, nice.
Okay, well, yeah, we'll see what we can do to raise that for
120 over 80, 90 something. That's
you're the pinnacle of health.
I took a lot of medicine, I kept at my health. Yeah, I need that. Okay, thank you very much. And today we have the question come from Paul Searle. And his question is, with the underlying job market showing signs of stress in certain areas and cracks in others, how do you think about the overall health of the consumer when you factor in what housing and the car loan industry is saying? That's it. Thank you.
Well, we did answer that question.
Yeah, so we're gonna raise his blood pressure. We already answered that one.
We answered that question, but
so here,
I think we should talk a little bit about inflation because we haven't done that.
Sure.
So I think it would be useful just to quickly talk about that. I was on Bloomberg this week. I had the opportunity to meet Governor Christopher Waller. So those that know me know that I rarely go into the studio, but knowing that Waller was going to be in the building, I made it a point to go down there and meet him.
Did you get an autograph?
No, surprisingly, not to toot my own horn, he knew who I was. So that was cool.
Was that good or bad?
No, I don't know.
You're that son of a Neil.
Well, I mean, I am an advocate for his candidacy on the street.
Yes.
I mean, everyone knows that. But I do find it interesting that we're talking a lot about inflation right now with oil prices collapsing. I mean, call that a peace dividend. With the labor markets slackening, right? So I mean, I do, and with housing rents continuing to slow. So you have lower oil prices, slacker jobs market, rents slowing down again. And here we have the hawks talking about, well, maybe we can cut one more time. Like, if inflation is slowing, even though you already cut last year, it just means that you misjudged what underlying inflation was in the first place. So it means you were already too tight, in my opinion. So I think that, so I think it makes sense to continue sort of advocating for rate cuts. There is a little bit of an interesting kind of, I guess, the sort of internal politics of the Fed. I mean, you have Myron out there he's clearly keeping the press office at the Fed very, very busy because he's been all over the place. I mean, he's got so many events that he's been doing. He's out there talking quite a bit. But it's pretty clear that he's going to dissent in favor of 50. Like, I wonder a little bit about how that works inside the committee, because the support for a 50 basis point move right now is very, very low. And he's been very clear that he's going to keep dissenting in favor of 50. So, I wonder whether that kind of puts Waller in a bit of a box because, let's say he starts advocating for 50. Does that create a situation where you don't have enough support to string out 25s on the committee as a result? Because the committee is very, very evenly divided. So, and it's a consensus building institution. So, it's important to kind of pick your spots. And if you're going in basically announcing what you're going to do, it's really difficult to be persuasive in that respect because you want to kind of make your case at the meeting also. So anyway, just my 2 cents. But I tend to sympathize with the doves on the committee. I mean, worrying about inflation with oil, coming down, with the rents coming down, with the labor markets looking a little worse. I mean, it just seems to be like a little ridiculous. I mean, you can talk about tariffs and uncertainty, but at the end of the day, tariffs have been put on and the pass-through hasn't been as much as you thought in the first place. So what does that tell you? You should be taking some signal from that. So
I mean, the 30-year yields, the 50-day crossed under the 200-day on the 30-year yield, right? Maybe 2 weeks ago now. Obviously, you're breaking down below 4% on the 10-year yield. You're 100% right, Neil. I mean, the bond market.
The 2-year yield is signaling cut.
Yes.
Stop talking and just get on with it.
Right. Shut up and sing.
Yeah, I mean, I hear what you're saying now on the market, but there was a time when, lower 2-year yields were a sign of potential caution on the outlook, right? I mean, the stock market's not lining up with that right now, obviously, but, it's interesting because obviously the bond market has a much different view of what nominal growth outlook is relative to where stocks are. And so, we'll see. But I think for the Fed, it's a pretty simple message. Like worrying about inflation here, and it's not in the U.S., truth be told. You have people like in the Bank of England where the labor markets, where the UK labor markets are worse than ours, and they're fretting about inflation and things like this. So, I just find that a little bit perplexing.
But a lot of times people, when they think about gold, when they think about inflation, they look to gold, right? As a marker. Is there anything there?
Well, we talked about this last week, right?
Yeah. Statistically, no.
Question, right? Yeah. I mean, I think you've got to look at global central banks. You've got to look at repatriation and flows. You have to look at all that stuff. Now, I will say from our what we call CERM, our kind of rolling alpha work, if you want to contextualize that and think about it. And I know that's not going to be helpful for a lot of people, but alpha's the excess return per unit of risk that you have above and beyond what you should expect from, say, the market. Anyway, so rolling alpha in gold is at levels that we saw back in the late 70s and early 80s, which is at the peak. So that's for us that is it's the initial flag of a bubble. It's not the final flag. It just says, hey, we are in an extraordinary environment, so be careful, right? Don't be Sir Isaac Newton. I mean, frankly, and we're not seeing that in equities, honestly, in terms of our quantitative data that we look at to do this. We are seeing it in gold. And so, for us, we talk about dollar cost selling. It is, you systematically peel portions of these gains off as you go, 10%, 20%, whatever it might be, with the idea that you're in an unsustainable at an unsustainable pace. You still want to keep and you still want to play. The most money is made by actually selling after the peak, not selling into the peak, because that's unknowable. But I would say gold is in that zone. We never hit on this last week, but Steve, I'd like your opinion on this. Pavlik, not Duttenhofer, or you can weigh in on it too, Duttenhofer. The Nobel Peace Prize, what happened? Like DJT, nothing. Which I will say, and I'm on the record of saying this, and only half kidding, that I would say that the market would peak when Donald Trump won the Nobel Peace Prize. So the good news is we're still a year away from a market peak.
Well, obviously what didn't happen was Trump winning the prize. Now, people point out that I guess the applications, if I understand it, need to be submitted to the Nobel Committee by January. I think what Trump supporters would point out is, well, Barack Obama won his first year in October, so there was no issue there. Look, I think I don't know that I'm not, in terms of constituting that's enough to win a Nobel Peace Prize or not, but I obviously that's the point of contention for the Trump people and how they view the Nobel, committee and with globalist institutions. But where I'll go in terms of things to look for next week is Trump, clearly focused on this Gaza deal that he brokered. And if things hold, then I think, to your point, Jeff, it bolsters his case to receive it next year. But where he's pivoting now is trying to resolve the situation with Ukraine. And you look at what to watch next week. Trump has tasked Secretary Rubio. He's been tasked with a lot of things, but apparently he's going to meet with his Russian counterparts to try to make some headway here. And I think that's important when I sort of think about the shutdown, in the sense, where's Trump's focus right now? It's on trade with China. It's on these upcoming swing through the Pacific and trade deals there. It's trying to secure peace in Ukraine. He's trying to position himself as sort of above the fray of doing something to reopen the government. And I think that's by design, because I think Senate Minority Leader Chuck Schumer sort of views Trump as a desired deal maker, that if he could just sort of negotiate directly with him, that they could find some off-ramp here. And my guess is there's some strategy behind this from Republican congressional leaders to sort of like keep Trump focused on things that he'd rather pursue, be above the fray. And so if you're trying to figure out when the shutdown's going to end, because of that and many other reasons, I don't see a near-term solution likely. The other thing I'll just mention to watch next week is, I believe the Chinese Communist Party is gathering formally for the fourth plenum meeting to produce their 5-year plan. The other thing they announced at these things are personnel changes. And you had Treasury Secretary Bessent complain about a lower level Chinese trade negotiator this week. So it'd be interesting to see whether that person is still in the role after the meeting earlier this week. If he's not, that's probably a good indication of a more positive reaction between Xi and Trump meeting. That said, Xi may not like the optics of trying to fire somebody because the U.S. is demanding it. So something to watch.
So belated thanks to Paul Ciro for that question. Twice we answered it. So we'll send you some golf balls and a hat too, because we have a lot of those. Steve, you were just talking about things to watch. Is there anything else on your radar this week on the horizon?
I think those are the big things to watch geopolitically. We'll see, related to China, if any positive momentum comes from these lower level talks, because you usually have to have those to really iron out the details and the issues for the leader meeting on the 29th of October. And then, hope springs eternal. It's possible they might find a way forward here on the shutdown, but I wouldn't bet on it.
Neil? Hey, we get CPI next week.
Hooray!
Something to talk about.
We also get the first sort of flash reading of manufacturing and services PMIs from the S&P Global. So we'll see how that shakes out. That's really all you have to go on right now, is these regional manufacturing prints and these sort of survey data points. So we'll get a little bit more of that as well.
Jeff?
Well, I think there's a couple things to watch. Let's see if we can get this oversold condition in regional banks to bounce, and frankly, most financials they should bounce. And we should start to see. I know we're still in October, so it might be a month away, but we should start to see discretionary pick up. So that'll be important to kind of help triangulate where we are within the market cycle. Discretionary should start to pick up again. Mostly because of rates, not the data. So that's an important distinction there. And, look, quietly, we saw, just yesterday, I think Micron made a new high and AMAT made a new high. So, are we able to still kind of keep this this perpetual motion machine going in these areas? But I'd like to see some of the sentiment burn off. It feels like that's happening in some of the fringe aspects of the market. Call it the quantum computing names, and maybe a little bit of these, uranium and alternative power plays. That'd be good to see, a little bit of cooling there. But again, I think that sets up more bullishly for 2026. So, but I'm always, I'm as people know on the pod, I'm a fully invested bear. So I'm always looking over my shoulder. And that's not to say I'm always fully invested, but I'm always looking over my shoulder for problems, and credit is usually one of the key areas. Frankly, I'm short the private equity aims in as an offset to the bullish overall position and condition of the market. So we'll keep watching that.
As always, good stuff, guys. Let's end it there. I remind people, go to renmac.com for more information on what we do. Get a free trial if you're not already seeing our work. We're happy to send that to you so you can see the abundance of stuff that we do. Big shout out to Stanley Shuckman at Columbia Tennis Team for being a watcher of our show. We'll send you a hat as well. Good luck to the Columbia Tennis Team at Princeton this week, and then for the rest of the season. But we'll be back next week when we'll be 1 week older, 1 week wiser. Until then, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Thanks, everybody. See you then.